Up to this point, we've looked only at the single-step income statement, which is a wonderful way to get familiar with the income statement and the way that the income statement measures the results of operations for a particular period. But the multi-step income statement is arguably more useful because it contains some subtotals along the way, this journey toward net income. Here's an example of a company that would use a multi-step income statement. I'm sure you've heard of Under Armour. In fact, I'm sure plenty of people watching this video own products that were merchandise sold by Under Armour. And Under Armour really is a merchandising company. If you were to look at their annual report, you will see that they don't manufacture their goods. They design, they market the goods. They contract the manufacturing to third parties. But nonetheless, as a merchandising company, Under Armour has inventories on the balance sheet. And that's one of the things that makes a merchandising company or a manufacturer somewhat different from a service company. Service companies really don't have inventory to be sold to customers. They may have supplies inventory, things that they would use internally to conduct their operations. But when we see merchandise inventory or inventory on the balance sheet, what we're really seeing is these are items that the company expects to resell to customers, hopefully at a profit. And you can see on the balance sheets here for Under Armour, 1.158 billion. By the way, this is billions because these numbers are in thousands. You have to add some zeros at the end of each one of these numbers. So Under Armour had nearly $1.2 billion worth of inventory at the end of 2017 and a little over $1 billion worth of inventory at the end of 2018. Just as a merchandiser's balance sheet looks different than a service company's balance sheet because of the presence of inventory, the multi-step income statement looks different for a merchandiser or for a manufacturing company as well. And it's again because of the presence of inventory. We have this thing called cost of goods sold. Cost of goods sold is an expense. We don't label it as such. We don't say that it's an expense, but we can clearly see that if you take the company's sales revenue for the period and then subtract the cost of goods sold, it nets out to this total called a gross profit, a subtotal called gross profit. Gross profit really measures the sale value that we earned above what we paid for the items, above the cost of goods sold. So gross profit is this first intermediate step in the journey toward the bottom line net income or loss of a company. Let's take a look at this multi-step income statement for a few minutes. Now, if we were to look at a single step income statement for Under Armour, the bottom line would be identical to what we see right here. Net income or net loss for the period doesn't change. It's simply the presentation of the elements that build into that net loss or that net income. In a single step income statement that we've seen thus far, we include all the revenues in one spot, and then we subtract all the expenses, and we just brute force get down to a bottom line net income. But the multi-step income statement categorizes things more functionally. So what we see here is that we have cost of goods sold, which is the cost of the items that we're selling, the revenue that we're generating, and that leads us to a subtotal called gross profit. Then we subtract operating expenses. In this case, we've aggregated them as selling general administrative expenses, and it looks like, and we may not see this in all income statements, but it looks like Under Armour had some restructuring or impairment charges. That may or may not be in every company's income statement, but it was significant enough for Under Armour that they decided to break that out from other expenses. Then we get to this subtotal called income or loss from operations. So when we see income or loss from operations, what you're seeing here is kind of the company's core operational performance. There are still other elements of the income statement that will affect the bottom line net income or net loss. For example, interest expense or miscellaneous other expense. That's certainly going to reduce the net income, or in this case, increase the loss. Companies have to pay income taxes, or they may have a benefit. In this case, we see a benefit for Under Armour because probably because of the net operating loss that we're seeing generated. They probably have a tax refund coming to them, or at least an overpayment, because they lost money, essentially, for 2018. That's why the income tax provision is actually a benefit this year, but it's an expense in each of these years. And then there's this kind of miscellaneous thing that's beyond the scope of our discussion here, income from equity method investments. That's essentially income from a subsidiary. But what you're seeing here is this income from operations. Remember that we're trying to predict future cash flows. Financial statements should help users assess future cash flows. How much future cash, how likely, and what is the timing? That's the reason for some of these subtotals. We can get a little bit more granular with the multi-step income statement than we do with the single-step income statement. And we can start to analyze the company's performance, not only with gross profit, but operational income, and then finally bottom line net income. As we start to analyze elements of the income statement, one of the things we need to look at is gross profit percentage. See, you might notice that as we look at the year 2016, then 2017, then 2018 for Under Armour, Under Armour's revenues increased each of those years. And you would expect that as revenues increase, the cost of goods sold should also increase because we have more merchandise we're selling. The cost of that merchandise will certainly increase. The quantities increase. And it doesn't surprise us probably that some of the selling general administrative expenses increase. So we need to have a mechanism for trying to compare the relative performance of multiple years when the magnitude of the dollars is different in one year versus another year. One of the things we can do is we can express gross profit as a percentage of revenues. So in other words, for this particular year, take the gross profit and divide it by the sales revenue. Now we're going to express gross profit in what we would call a common size manner. In other words, in terms of $1, in terms of a percentage. How many cents per revenue dollar did we earn in terms of gross profit? We're going to take a look at those trends in just a second. The same income statement we've been looking at, I've put it over here. It's a little smaller, and if you need to see some of the details, I'm sure you can rewind the video slightly. But this is the same information we've been dealing with. What I want to do is I want to show you the trend for this particular company over the 3 years that are depicted. So gross profit percentage is simply going to be your gross profit divided by your sales revenue, in this case net sales revenue. And then of course that would be a decimal, so you need to multiply it times 100 to get to a percentage, but that's your gross profit percentage. So looking at a company's performance over time is one of the ways that we can analyze its health. Take a look at Under Armour. We see that for 2016, the gross profit percentage was 46.5%. Then it dropped down to 45.1% for the years 2017 and the years 2018. So we're seeing a decline in profitability, at least over this 3-year window that we're looking at. Just as a reminder, what this really means is this. For every dollar, if we just take a look at 2016 as an example, for every dollar of sales revenue that Under Armour generated, on average, they earned 46.5 cents of gross profit. That's one of the ways to think about the gross profit percentage. So we can certainly look at one company and look at its performance over time, what we would call a trend analysis, but it's also important to benchmark companies against their competitors, those companies that are performing similar services or selling similar goods, maybe in the same industry, so we can get a sense for their relative performance. So looking at a company's performance on a trend basis within the same company is important, but it's also critical to take a look at competitive benchmarking. So I looked at companies that were similar to Under Armour, and Lululemon, maybe not exactly the same as Under Armour, but similar enough that it would be interesting to compare their relative performance. Under Armour markets athletic apparel and gear to consumers, and the same is true for Lululemon. Neither one of the companies manufactures its own products. They design, sell, promote, market the products, but they contract out the manufacturing. So there's enough similarity that it'd be interesting to draw these comparisons. Another reason that I wanted to take a look at Lululemon was this fiscal year concept. You'll notice a subtle nuance. Let's go back for a second to Under Armour's operational statement. So the multi-step income statement for Under Armour uses the Gregorian calendar. Starts on January 1, ends on December 31. It's for the year ended December 31, each of these particular years. Not the same for Lululemon. They use a fiscal year. They're still measuring approximately 365 days in each particular fiscal period. In Lululemon's case, it's going to be either a 52 or a 53-week year. And we'll get into that nuance in just a second here. But it's important to understand that we're still measuring, mostly what a Gregorian calendar would, but the timing is shifted. It's the fiscal year ended January 29, then ended January 28. Now we're into February 3. And you might be wondering, is there any rhyme or reason to this? Well, notice this. January 29, 2017, that is the last Sunday in January. Let's take a look at Lululemon's annual report to see if we can draw any conclusions regarding how they select this fiscal year. For clarity regarding this fiscal year, I consulted the notes to the company's financial statements. Remember that the 4 basic financial statements are a great start in measuring and evaluating the performance of a company. But the notes to the financial statements are so critical in the analysis because they place the financial statements in context. They can provide answers to questions that we may have as we look at the financial statements. And one of the questions you might be having is, how did they pick these fiscal years? Well, look at this note, the basis of presentation. These consolidated financial statements, first of all, it's good to know that they're presented according to U.S. GAAP. Okay, it's good to know the framework being used. But it says the company's fiscal year ends on the Sunday closest to January 31 of the following year, typically resulting in a 52-week year, but occasionally giving rise to a 53-week year. Okay? So now we see this. It's the Sunday closest to January 31. That's why for 2017, we're all the way down here. This is the Sunday closest to January 31. And then the next year, this Sunday closest to January 31. Now it happens to be at the end of 2019's fiscal year, or at the fiscal year ended in 2019, is that the Sunday closest to January 31, because here's January 31 right here, happens to be in February. So what we're seeing with Lululemon, and this is not a surprise for a retailer, is that they're trying to end their fiscal year very close to the end of January, but they're trying to do it also on a weekly basis. I mean, they certainly could have just said that our fiscal year ends on January 31 of each year, and that would have been fine. But what they're trying to accomplish here is they're trying to have their fiscal year end always on a Sunday. Think about the retail trade for a minute, okay? There certainly is an ebb and flow of retail activity throughout the week. A Saturday, a Sunday, a Friday, those days are probably going to generate more sales activity than something earlier in the week. People tend to go to the mall and do online shopping and whatnot, more likely toward the weekend. There's a rise in activity. Hence, Lululemon's desire to have the fiscal year end on a Sunday. And closest to the end of January, why do they pick that? It's because of the pattern of seasonality. Think about holiday shopping. Think about the fact that by the time the end of January rolls around, inventory levels are probably at the lowest level they will be throughout the year. The earnings process is substantially complete. At least it's at the most complete level it will be for the entire year for a retail apparel business. By the time the end of January has rolled around, most of the returns from holiday sales probably will have already occurred. So it's just a natural end to the company's fiscal or financial year for a retail apparel business. Like I said, they could have just ended it on January 31, but they also wanted to go a step further and basically say, we know that within any given week, there's kind of an ebb and flow of activity, so the end of a day on Sunday really seems to be the best choice. So in this case, Lululemon chooses a fiscal year that ends, in this case, end of January, end of January, somewhere toward the beginning of February. And we can even see that there was a 53-week year for fiscal 2018, even though fiscal 17 and 16 have 52-week years. So we would need to take that into account if we're analyzing the performance of this company. Enough on fiscal years. I just wanted to discuss that nuance. Let's take a moment now and compare Lululemon with Under Armour. So here's the gross profit trend for Under Armour from 2016 to 2018. We already took a look at that. Here's the gross profit trend for Lululemon. And you know, it's not going to line up perfectly because, again, Under Armour is using the Gregorian calendar, whereas Lululemon is using a fiscal year. But we can still get a sense for the relative profitability. Now, Lululemon is a smaller company. What do we have here? 2.3 billion in revenues, 2.6, 3.3, a growing company for sure. Whereas Under Armour, a little bit of a bigger dog, okay, at 4.8 billion, 4.9 billion, bumping over 5 billion here. But one of the things that's interesting is that the gross profit performance for Lululemon is definitely, I'd say, more attractive than what we're seeing for Under Armour. Under Armour here, 46%, then down to just above 45%, whereas Lululemon, we see 51%, and then bumping up to nearly 53%, and then pushing over 55% as well. Now, this certainly is interesting for comparison. I think it's important to note that they're not identical competitors. There are, for example, things that Under Armour sells, like shoes, that I don't believe Lululemon sells, but they're not completely dissimilar either. And if I were going to compare the financial performance of these two companies, especially as an investor, one of the things I would look at is the relative gross profit percentages. Lululemon does appear to generate a more robust gross profit. 55 cents for every dollar versus 45 cents for every dollar of revenue. I'll let you make the decision yourself. Beyond just comparing the relative gross profit of both companies, we can also look at the bottom line net income and also the income or loss from operations. You might recall that Under Armour, we actually saw a couple of years where the company generated a net loss instead of a net income. And just like we can measure gross profit as a percentage of sales, you can take your net income. For example, in this case, $256,979. It's actually $256 million. Okay, let's just point it out that way because you have to add your zeros. So you can take this 256, almost 257 million, divide it into the 4.8 billion in sales revenue to arrive at a 5.3% net profit margin. What that means is that for 2016, on average, for every dollar of sales revenue generated, Under Armour earned 5.3 pennies. And during 2017 and 2018, for every dollar of sales revenue generated, they actually lost a little bit of money. Now, we can compare with Lululemon. Operating income, even though we're talking about smaller dollars because Lululemon has a smaller revenue base, we can see that not only is their gross profit more attractive, but their operating income, 18%, 17, 21, almost 22%, far exceeds what we're seeing here reported by Under Armour. And this is publicly available information. You can look up their 10Ks and annual reports. You can get them online. That's how I obtained this information. And we're also seeing that the bottom line net income is stronger. Now, this could be life cycle of a company, could be slight differences in their product mix, could be restructuring and reorganization like we saw with Under Armour. Under Armour is roughly 2 years older than Lululemon, so it's a slightly older company, could be at a slightly different life cycle stage of the business. These are all things that we have to place in context, but at the end of the day, notice how we can use common size terms, common size metrics, gross profit percentage, operating income percentage, and bottom line net income, sometimes called just profit margin, bottom line profit margin, but we can use these common size metrics to compare two different companies that are two different sizes and draw some conclusions about their relative operational performance.